Hi everyone, I'm Laurel Marie Hickey. Welcome to What's Blank Got to Do With It. Today's What's Blank topic, Bonds 101. So what's Bonds 101 got to do with it? So I find that most portfolios do have a combination of stocks and bonds, but it is the stocks that get the airplay. Everyone's always talking about their stocks. My stocks are up this, my stocks are down that. But they really don't talk about how their bonds are doing. So I thought we would share a little bit about what a bond debt instrument is. So essentially what a bond is, it's a loan. So we all know what a loan is, right? So you are lending your money to a corporation or to a province or to a government or to a municipality as an example, and you want to get your money back at maturity. You have a predetermined date that you are going to get your money back, and you would receive an interest rate for putting your money at risk in the market, in the bond market. So you've chosen this bond instrument to put your money into, and your hope is, based on the credit quality of the company and the time horizon that you've put it in, that you would get your money back. But there is risk as well. So you have to really look at the bond rating system. Is the bond a triple A, an A, a B, a triple B, and so on. So it's really important to look at the credit quality of the bond. But let's just assume it is a 1-year bond and it's a good credit quality bond, and you feel that it's worth it to put your money at risk in this bond investment. So you put $1,000 in, you get $1,000 at the end, and throughout the life of it, let's assume that the 1 year is 5%. Now, interest rates really do fluctuate up and down. So this is just an example, 1-year bond, 5%. So you know that you're going to get your money back 1 year out if the credit quality is good, and throughout the life of it, you're going to get your 5%. So you would receive that 5% cut in 2 different payments. Bonds pay on a semi-annual basis, so you get the first one halfway through, so 6 months into owning the bond, and the rest of the money you would get at maturity 1 year out. So why does a corporation or a province or a municipality or a government issue bonds? Typically, they have a project that they need the money for. So they have a capital expenditure program, and the bond market has been readily available in the past. So it's been fairly easy for them to raise money when they do need it for their projects. Bonds are issued anywhere from 1 to 30 years. So if you had a really long project, you would issue a long bond. If you had a very short project, you would issue a short bond. So very important to look at credit quality, time horizon, and how that fits in with your own investment objectives, and have conversations with your trusted advisor on what bonds that you should have in your portfolio, what is attractive based on your own risk tolerance. So sounds pretty simple, right? Loan your money out, get an interest rate, get a fixed price at a predetermined date in the future. Well, then along comes an interest rate environment. So the bond market is just as fluid as the equity market, and I'll give you a couple of theoretical examples. Let's assume that you buy that bond, your purchase price is 100, and you know that it's going to mature at 100, so you bought it at 100, you're going to mature at 100, throughout the life of that investment, you're going to get 5%. Well, let's imagine, a month later, all of a sudden interest rates go up. So it's an inverse relationship with interest rates. So as interest rates go up, the bond price goes down. And so when interest rates go down, bond prices go up. So it's an inverse relationship. Let's start with an interest rate rising environment first, because that is the environment that we're currently in. So say you just bought your bond at 100, and now interest rates have gone up after you've purchased that bond. And now that bond price is trading lower than your purchase price. So it's trading at 90 as an example. First time you bought it 100, now it's at 90. It still is the same bond. It's still going to mature 1 year out. You're still going to get your 5% interest. It's just now, if you buy it at a discount, you're going to make a little bit of money on the the difference between what you bought it at and the maturity date. So that is your yield, for total yield for the portfolio. So you're going to make money on the initial part of it by buying it at a discount, having it mature apart, and you're also going to make interest on throughout the life of it. So yield to maturity is that calculation. So when we do have this interest rate rising cycle, it's very interesting on how that is valued for bonds. Now let's assume that interest rates go down. So now you have purchased that bond, you paid $100 for it, and then interest rates went down after you purchased it. So what would happen with the value of your bond if it's an inverse relationship? The value of that bond would go up. So let's just say, as an example, you bought it for $100, you're getting your 5%, but now interest rates have come down to say 4%. As an example, your bond would be trading likely above 100. So technically, you could actually sell the bond at a premium, or you could wait till maturity and know that it will mature at your fixed 100 price. So in an interest rate rising or interest rate declining cycle, we do see the value of prices going up or down. And there's a big difference between the value of prices going up or down in the short end of the curve, short-term bonds, and the long end of the curve, long-term bonds. So it's very interesting to see those swings in prices. So many investors typically will ride out the volatility and wait for the maturity of their bond. So they recognize that the value is going to go up or down throughout the life of the investment. But as long as the company has good credit quality, they want to hold on to that bond until maturity because they feel that they will get their money back. So a passive bond strategy would be to buy the bond and to wait for maturity. Many investors do that. There are a lot of other opportunities available to investors. So typically, if you wanted to buy a bond, you would reach out to your trusted advisor, portfolio manager, wealth advisor, and have that conversation about bonds where they would explain the risks and the rewards. You can also buy bonds in other solutions. So there are exchange traded fund bond positions, so ETF bonds. There are mutual fund bond positions. So there's lots of ways for you to have exposure to bonds, and perhaps a more active way of holding bonds because that manager is doing the buying and the selling of the bonds. So they're taking advantage of opportunities or mitigating on the downside. So it's really great to have a combination of passive as well as active strategies for your bonds. I always say it's super important to invest in a way that you're aligned with, ask the right questions. There are risks and rewards to investing, and it's important to be able to really dive into a topic and have an engaging conversation with your advisor. I'm always here if you have any questions. Until next time, I'm Laurel Marie Hickey.